Welcome to the latest edition of our water cooler series. It's that time of year again where we've now released our Goodwill Report, reporting all of the transactions that took place that Dental Elite acted on in the last 12 months, in the last fiscal year. And the data is quite interesting as ever. So Phil, what was your sort of takeaways?
I guess, look, in 2023, 2024, interest rates were rising. There was a lot of uncertainty in the market. So I think, first of all, the market was a lot more sure. In 2024, 2025, people realised, independents realised where interest rates were, and the long-term view is they will start to come down. So that's fueled the market from an independent perspective. And likewise, from a group perspective, what we're starting to see is the emergence of micro-consolidators. So the report does largely focus on the benefits of potential sales to micro-consolidators and independents as corporate activity starts to slow down somewhat.
Yeah, I think the report is split into two sections. So it talks about sales to independents, but as Phil alluded to, also sales to groups. And I guess there's a few sort of interesting takeaways from my side in the sales to group section. The first, as you alluded to, is that tier 4 consolidators. Now we class them as people who've bought anywhere between who have anywhere between 3 and 10 practices in their estate. They paid the highest average multiple in the last fiscal year beyond what the tier 1s and the tier 2s were doing. Now the tier 1s are the sort of the big boys, tier 2s are anyone sort of north for 20 practices. Now, I guess what's interesting is more to the average sale value. Now, I don't always tend to read much into average sale value because it all depends on the deals we act on in the year. But I think what is quite noticeable is the average sale values for tier 1 and tier 2 transactions were both over £3 million. And I think anecdotally, I don't know if you'd agree, I think that's probably representative of how the bigger groups have moved away from buying a lot of smaller stock, which is what they did when we sort of had the land grab of sort of 3-4 years ago, is now it has to be big and it has to be attractive for them to go for it.
Yeah, well, speaking to all of the bigger groups, is they're kind of risk adverse at this moment of time. So normally with bigger sites, the sites that sell for circa 3 million, is you have revenue delivered by multiple clinicians, a hygiene service. So from their perspective, it's a well-managed and less risky business than potentially a smaller practice in which the majority of income is derived by, let's say, a principal dentist. So undoubtedly the groups are looking at acquiring bigger practices, high levels of EBITDA which they can integrate and maybe have less area managers than actually having, buying 10 sites with 200k EBITDA which they deem risky businesses.
Yeah, and they want to hedge that recruitment risk as well. Because there's still the recruitment challenges out there, albeit I would say they're probably less so than there was sort of a year to 18 months ago. And I think that's represented when you look at some of the regional data for the groups, because there's not actually that much disparity when you apply numbers between what a practice sells for in the Northwest conversely to what it sells for in London and the Southeast. But if you go out to the real regions, so sort of the Northeast or the Southwest Peninsula, that's where you do see an average multiple drop of probably a good half a turn. And I think that's representative that it's two things. First of all, recruitment risk, and secondly, there just isn't the volume of consolidators in those areas.
It's competition.
Yeah.
So in them areas, there's less competition from groups. Slightly, you then start to get the tier 4 consolidators. And one point on tier 4s, and what this report really doesn't break down, is although we touch on multiples, we don't touch on deal structure.
Yeah.
And certainly, if anybody's out there is looking to market their business, going to the whole market and attracting tier 4 interest, you may get a better multiple, but equally, the terms may be considerably better than if you went for a tier 1 or a tier 2. So the report doesn't really go into independent deal structures.
Yeah, and I guess that's the thing, isn't it? Is that often with a group, if you're selling, you're getting 70% up front, and often there's the 3-year tie-in. On a typical average, obviously deals do vary. But I guess if someone's going to pay you 100 grand less, but let you walk away with all the money at the point of completion, you can invest that and probably earn a lot of that back. And secondly, I guess is once you've sold, it kind of takes that stressful headache, and that might be a purpose of sale anyway. Yeah,
and there has been a noticeable change in groups actually looking at deferred elements and being slightly more flexible than probably what they were 6 to 12 months ago. And I think that's a slight change into the market where groups are acknowledging the tier 4 buyers and how competitive they are.
Yeah.
And they're almost having to look at ways to make their offer slightly more attractive, because equally, they want to acquire. So there's a lot of diversification in the market.
And just one final point I wanted to pick up on with regard to groups is that you'll notice in the survey that there isn't an average for NHS practices sold to tier 1 consolidators. Now, the easy takeaway from that is to say that the biggest groups aren't acquiring predominantly NHS practices, but that wouldn't be correct. I think what probably is the takeaway, is that if you've got a bigger practice of 28 to 30,000 UDAs now, it's really, really rare to find that practice that is still exclusively NHS. Most people who've got that size of practice have moved their business model towards a more mixed income business model. So those groups who you would perceive are predominantly NHS are acquiring, but they're acquiring mixed practices because to acquire at the level of EBITDA that they want to acquire, those businesses are now mixed. They're not exclusively NHS anymore.
Yeah, and just to clarify, in terms of mixed, anything on an 80-20 ratio is considered a mixed practice. So, that is, like you said, most bigger practices have diversified because they realise actually to maintain their EBITDA or to grow their EBITDA, they need private income. They can't just rely on NHS income, which goes up by, let's say, 4.64%, and already it's been muted this week that the NHS contracts may only rise by 3% this year, and that will have an impact in terms of NHS profitability for small, medium and large NHS sites to deliver the same EBITDA, especially with national minimum wage increase.
So the headline national average for sales to groups in terms of the multiple of EBITDA was 7.16, but within that there is deals that sold at 10.6 times and also deals that sold at a lot lower multiples. So you can download the report by clicking the link, or of course you can catch us at any of the big trade events over the summer where we'll happily have a discussion with you about it.